Welcome to Looking at the Markets with David Modell. Today I wanted to explain a triple moving average crossover strategy. It will use three different moving averages. And the ones that I'll be showing today will be mostly for swing trading because it's a daily candlestick chart, but you can also apply this to the 5-minute candlestick chart, 1 minute, 2 minute. You can day trade with it, whatever you want. All right, so just adjust it accordingly. And I want to give credit. This website we're looking at right now is stockcharts.com. And this is the daily candlestick chart for Kroger. And what I've put up here is the exponential moving average, actually three of them, the 15-period exponential moving average, the 25-period, and the 50-period. You can also use simple moving averages instead of exponential moving averages if you want to. It all depends on your preference, but they both can work. All right, so as you can see, the slower moving average is the 50-day exponential moving average. That's the green line, okay? It moves more slowly. And then slightly faster than that is the 25-day moving average, and that's red. So the 50 is in green here. And the 25-day exponential moving average is red. And then the fastest one is the 15-day exponential moving average, and that is in blue. That's the blue one here. All right. And the reason that you can use three moving averages is because if you just use two moving averages, like for example the blue and the red, which are the 15 and the 25, you get a lot of noise here. They're right on top of each other sometimes. You get some false signals. You don't get clear breaks. Over here, you got it, the 15 going kind of below and kind of above, below, above. They're right on top of each other practically. Same with over here. You get some false signals. And you might not even be sure when to buy, when to sell. So what you can do is add a third moving average. Here I've added the 50 in addition to the 15 and the 25. All right. And so since I want to be clear as to when I'm going to buy or take a long position, instead of just deciding, well, I'll wait until the 15, the blue, goes above the 25, the red one. Again, you got all these false signals here. It's not clear when it breaks above. So instead, to make it more clear, I'm going to wait to take a long position or to buy the stock. I'm going to wait until the 15 goes above the green one, the 50. That way you get a more clear break, all right? So when the blue goes above the green, you can clearly see it, and you don't get all those false signals. You don't get all that muddled confusion there, all right? So that's totally clear as to when you buy. And if you bought here, you would have done quite nicely with that run-up without eating up your trading account with commission costs and just aggravation of false signals here, all right? Now, I like to get out sooner rather than later, all right? And this is a pretty good example. We can see that Kroger stock has just dropped rather sharply recently. And so instead of waiting until the 15 goes below the 50, because by the time that happened, it probably would have been too late. All right. You see the 15 start to go toward the 50, and it doesn't really have a clear break below. The 15 doesn't go clearly below the 50 until the candles are way down here, and it's a little bit too late. You're already in some trouble here. So I like to get out sooner rather than later. All right. I like to be safe in my exits. So instead, what I will do is I'll just wait until the 15 goes below the 25, which happens clearly right here. So I would have gotten out here instead of over here. Okay. So when it comes to entries, I like to be a little safer. I like to wait a little bit longer until there's a clear break, and I don't like all the confusion. And so once again, just to review, you can wait until the 15 goes above the 50, the green line, and not the 25, so as to avoid the entries that are too early and all the confusion here, okay? But to get out, rather than wait until the 15 goes below the 50, you can just wait until the 15 goes below the 25. You'll get out earlier, like right here. And yeah, sometimes you'll take profits a little bit early, but that's okay. At least you'll be avoiding, so you could possibly sometimes avoid big, sharp downturns. And that's the idea, all right? So this is just one example. I want you to make your own decisions, do your own due diligence, okay? I cannot tell you what to buy or what to sell. This is just one strategy that I have found to be helpful with 3 moving averages rather than just 2. So I hope this was helpful to you, and what I can do is offer more help to you if you need it or if you'd like it. You can contact me. My name is David Modell, and my email address is davidmodell@gmail.com. I can help you to set up a trading or investing plan, because you've got to have a plan. If you don't have a plan, then you're just planning to fail. Or if you're just not getting the results that you like, you can contact me. Again, davidmodell@gmail.com. If you like this video, if you found it helpful, please give it a thumbs up and leave a comment in the comments section below this video. And if you have not subscribed yet, please subscribe to my YouTube channel so you can receive the latest updates on all of my financial educational videos. Thank you so much for watching and listening, and I'll talk to you again soon.